Hey everyone, let's break down why oil prices are going absolutely wild right now, and what you as an investor need to know before making your next move. So here's the headline. As of June 25th, oil prices just fell off a cliff. WTI crude is down over 5%, sitting at around $65 a barrel. Brent dropped more than 6%. Just 2 days ago, we were pushing $77. What happened? It was all about the Middle East. Over the weekend, U.S. airstrikes hit Iranian nuclear sites, and traders freaked out. Oil spiked, because if there's one thing the market hates, it's a threat to the Strait of Hormuz, the world's busiest oil choke point. But then, plot twist. Iran's response was pretty chill, and boom, a ceasefire between Iran and Israel. Suddenly all those what-if supply fears, gone. The risk premium that had been baked into prices just evaporated. Now markets are looking bearish in the short term. Technicals are ugly. Think of that as the market's mood ring flashing red. We're seeing what's called a bearish engulfing pattern, and momentum's pointing down. Some analysts see support at $57 and even as low as $44 if things keep sliding. But let's zoom out. The International Energy Agency sees a tighter market come Q3. Why? OPEC Plus is sticking with production cuts, summer travel is booming, and global oil inventories are still below average. The IEA says we'll probably stay in a slight supply deficit through the summer. Still, supply's not standing still. Kazakhstan just raised its output forecast, and Guyana is ramping up production big time. Plus, OPEC Plus countries are quietly boosting output, and with the US letting China keep buying Iranian oil, there's more crude sloshing around than you might think. Demand's growing, about 1.1 million barrels per day this year, but China's recovery is sluggish, and that's putting a lid on things. Meanwhile, the bigger financial picture is shifting. The ceasefire news sent stocks flying, but oil producers like Chevron and Exxon took a hit, down as much as 3%. Gold's down too as investors move out of safe havens. The Fed's still on the fence with interest rates, so don't expect that to save oil prices just yet. So, should you go long or short? Short term, the path of least resistance looks lower. No more war premium, bearish technicals, and rising supply. If you're trading, short might be your friend, unless the Middle East heats up again. But long term, watch those OPEC Plus cuts and summer demand. If inventories stay low or the ceasefire falls apart, oil could rip higher in a heartbeat. Bottom line, stay nimble, stay informed, and don't blink. Because in the oil market, things can change fast. Thanks for tuning in, and I'll catch you in the next one.